Hello there. Today let's learn how to mind map IAS 12. Income taxes. By looking at Statement of Comprehensive Income. At the tax expense figure. Tax expense figure is the total of current tax expense and deferred tax expense or credit. Current tax. It's the income taxes payable, that is payable for the current period, in respect of the taxable profit, loss to the tax authorities. Deferred tax expense, credit. The income taxes that would be payable, relief, that is in future period, in respect of the taxable profit, loss to the tax authorities. IAS 12 income taxes, requires the calculation of the both figures. Okay. Now we have understand the requirement of IAS 12. Let's understand the calculation and accounting for current tax. Tax is paid on taxable profit, income. Accounting for current tax is simple forward calculation. When the financial statements are prepared, the tax charge on accounting profits for the year is likely to be an estimate, which is therefore not the amount of tax that will eventually be payable. The actual tax charge, based on taxable profit, agreed with the tax authorities is likely to be different. Accounting profit is the profit, loss for a period before deducting tax expense. A series of adjustments is made against a company's accounting profit to arrive at its taxable profit. Adjustments involve adding back inadmissible deductions, deducting admissible deductions. Then, current tax is calculated by applying a tax rate provided by tax authorities on taxable profit, income. Current tax is an expense, a debit, in statement of profit, loss, with the other sided tax payable, a credit, under current liabilities, in statement of financial position. Calculation and accounting for deferred tax. Accounting for deferred tax is based on the principle that tax consequence of an item should be recognized in the same period as the item is recognized, that is matching concept. Accounting for deferred tax is based on tax base, which is the amount attributed to asset, liability as per tax authorities, and the identification of temporary differences, which is the difference between carrying amount of an asset or liability and its tax base. IAS 12 gives guidance on tax base of asset and liability, with taxable temporary differences and deductible temporary differences. Tax base. Tax base of asset and tax base of liability. IAS gives further guidance on assets charged to profit and loss, and assets convertible into cash, other asset, along with tax base of liability that are charged to profit and loss, and other liability. Tax base of assets charged to profit and loss. Tax base is the total amount of expense that will be allowed as expense in future. For example, property, plant and equipment will be charged in profit, loss as expense over the period. Tax base of assets convertible into cash, other asset. The amount that would be received in future but not taxable by tax authorities. For example, for receivables, are taxed on received basis. So the tax base is 0, nil, for today, as there would be 0 amount to be received in future, but not taxable. Tax base of liability charged to profit and loss. The tax base is its carrying amount less the amount on which no tax will be imposed in future. For example, revenue received in advance. Tax base of other liability. The tax base is its carrying amount less the amount that will be allowed as expense in future. For example, payment to account payable. Temporary differences. Temporary differences are either taxable temporary differences or deductible temporary differences. Taxable temporary differences. The difference which results in taxable amounts in determining taxable profit, loss of future periods. They caused by debit balance in carrying amount of asset, liability as compared to tax base. They lead to deferred tax liabilities. Deductible temporary differences. The differences which results in deductible amounts in determining taxable profit, loss of future periods. They are caused by a credit balance in carrying amount of asset, liability in financial statement compared to tax base. They lead to deferred tax assets. Deferred tax recognition and measurement rules. A tax rate, provided by tax authorities, is applied on temporary differences to reach the deferred tax liability, or deferred tax asset amount. Deferred tax liability. These are the amounts of income taxes payable in future periods. It must be recognized for all taxable temporary difference, except on initial recognition of goodwill. Deferred tax asset. These are the amounts of income taxes recoverable in future periods in respect of all deductible temporary differences. A deferred tax asset must be recognized for carry-forward unused tax losses and credits. Double entry for deferred tax. Deferred tax expense, credit. These are charged to profit and loss. Deferred tax liability, asset. These are recorded as balance sheet item. Thanks for watching. More stuff coming soon.